Welcome back to Squawk Box. Rick Santelli here with breaking news. Well, our October read on import-export prices and retail sales. Let's start with import prices, shall we? Up 1.2%, a little higher than expected. And if we strip out petroleum, up 0.5%. Definitely higher than expected. Year-over-year import prices up 10.7%. 10.7%. That is the highest going back to June. And if we look at export prices month over month, up 1.5%. That's well hotter than the 1% we were expecting. And buckle up, year-over-year export prices, drum roll please, up 18%. That is the hottest ever going back to 1984. Retail sales for October up 1.7, 0.3 better than expected, a full percent higher than what is still unrevised at 0.7 in the rearview mirror. Ex-autos up 1.7. Ex-autos and gas stations, remember the price of gas, this isn't adjusted for inflation. That is up 1.4%, double expectations. The control number, which is plugged into higher numbers up the economic food chain, that is up 1.6. 1.6. That is really a very, very solid number. So as I look across all these data points, what really jumps out at me, obviously, is that year-over-year export price index. And do remember, as I pointed out, and I want to underscore, Joe, is that these retail sales numbers are not adjusted for inflation. So higher inflation makes the numbers a little bit hotter. And with regard to import-export, I will throw this out there. Imports, as we learned from the last trade deficit number, were roughly around $290 billion. Well, at the end of 2019, they were about $250 billion. So we've also seen a marked increase in imports. That activity, of course, is due to some of the logistic problems and some of the supply shortages. Interest rates, well, we're over 1.6% in 10s, almost at 162. We're toying with 2% in 30-year bonds. The yield curve is starting to steepen a bit, and the dollar index is on a roll. Highest close yesterday since July of 2020, and it's looking a little bit higher today as well. Back to you, Joe.
All right, Rick, thank you. Steve Leisman joins us now with more. Hey, Steve.
Yeah, this is a good report with all of the caveats that Rick just laid out. We don't know how much of this is inflation. We can maybe guess. You do 0.3, 0.4, 0.5, sometimes even 0.6 on the inflation number, so you may want to take that out. You may not. But these are good beats. These are good numbers. It's a good way to start the quarter. That's also important. The other thing I like about these numbers, Joe, is that it's pretty widespread in terms of the growth. Seeing autos up for a second month in a row, there were like 5 monthly declines. It looks like perhaps maybe the auto situation is stabilizing. I don't think it's that easy to buy a car these days. I happen to be trying to get one. It's not that easy, but it looks like they're making a little progress in stabilizing the situations. Autos up 1.8. Of course, gasoline up 3.9%. People may be buying more gasoline, but more importantly, they're probably paying a higher price. Clothing was down. That was the one aspect, and restaurants were flatlined at 0. I don't even believe that number. I certainly think it's going to pick up. But the other thing I like was department store sales up 2.2%. Also, non-store retail is up 4%. A story here, I think, is twofold. You got the inflation number coming in, but you also have maybe a little earlier Christmas shopping. People concerned about not being able to get the stuff they want for the holidays, may be out there earlier doing some shopping when you could be pulling forward some of that Christmas or holiday shopping. Hard to know. Maybe you see that department store number up 2.2%. Maybe you see it in the non-store retail numbers. But those are things we're going to be looking at. Everything is different, Joe. We're going to be opening up. Another trend we're looking for very quickly is a shift. Retail sales is really the goods part of the economy. We're looking whether or not people move from goods over to services. So we should see the service sector pick up over the next couple months, Joe.